Hello, everybody. Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. The NYC floor is temporarily closed. We're coming to you remotely. Our guests today, Nicholas Colas from DataTrek and Reggie Browne from GTS. Nick, I want to start with you. You look at alternative data sets. I want to look at a fairly 30,000-foot view right now. You look at things like air pollution and auto traffic in China. What is your sense of the curve of this pandemic on the United States?
You know, Bob, so far we're seeing very good compliance with work at home, stay out of public places, don't move around a lot. You know, in New York City, for example, where I'm at right now, the traffic data shows that we're basically flat. There is zero congestion, and that's actually the lowest levels of the past week. So as quiet as New York was last week, it's even quieter this week. And it's the same kind of cadence all over the U.S.
Nick, let me interrupt for just a minute. I'm not hearing your response here. I'm hearing CNBC's feed here. So if they could just flip me over into your channel here, I can hear your response here. That'd be very helpful. Can we get Nick up?
Sure.
All right, Nick, can you hear me?
I can.
Okay, I'm sorry about that right at the top. You know, it's remarkable this technology actually works so well. Every once in a while you get a little bit of a glitch. I didn't hear your response, though, your 30,000 viewpoint view, because it's fascinating to watch you talk about things like auto emissions or emission levels in China here. Just abbreviate your response for me so I can get the gist of what you were saying.
Sure. You know, the bottom line is we're seeing very good compliance in the U.S. with work at home, stay at home requests by the federal and local governments. In New York, for example, the traffic levels that we're seeing right now, and I've got this up on my screen as of the last hour, congestion levels in New York City are at their lowest, even lower levels than last week. The weekend traffic was basically zero. So in New York, really the epicenter, we're seeing excellent compliance. People aren't moving around, and that's broadly true across the U.S. If you compare that to China, they had very similar levels of traffic congestion when they were on lockdown. The interesting thing is that as they've started to bring the economy back up to life, the weekday traffic is getting back to normal. The weekend traffic, which is consumer traffic, discretionary traffic, is still at quite low levels. So they're doing a good job of bringing the economy back up, but consumer confidence just isn't there yet.
But these levels that we saw when their traffic was essentially zero, like we're seeing in New York now, that was 2 months ago, essentially. Is it fair to try to extrapolate, if we continue with the social distancing, that we can have similar rebounds, or is that too much to ask or too much to extrapolate from the data?
You know, it's early to say, but I'd say, you know, the Chinese experience was very bad. They did a very good job of locking things down, and they were able to come back up, particularly in important cities like Shenzhen and Beijing and Shanghai. They were able to come back up to quasi-normal levels of weekday activity within a month. So that is a promising sign. If we're thinking about what the exit of this is for the U.S., they were able to do it. We should be able to accomplish something similar.
Okay, Reggie, let me turn to you. We have seen enormous flows in ETFs. I've watched the SPY, the largest ETF. We've seen essentially 4 times normal volume in the last month or so. I was particularly interested in watching the corporate bond ETF, the LQD. Last week, we saw a 25% increase in the shares outstanding. I think the prices were up 20%. And essentially, it seemed like investors were trying to front-run the Federal Reserve, who announced that they were going to be buying corporate bonds and corporate bond ETFs. I wonder if you could comment on what you saw there. There was a lot of criticism that in the LQD closed their prices with different from the net asset value by about 5% at a discount. And I guess the question is, who was wrong here? Was the ETF model wrong, or was it the bond pricing model that was wrong here?
Well, first, thanks, Bob, for having me on. One, I'd like to just first point out, ETFs were born out of the 87 crash when the stock market went down 22% to actually help exhaust the risk transfer and make it orderly and efficient. I think ETFs have performed terrific during this time period. If you look at LQD and SPY, 2 of the biggest ETFs, have essentially become the risk transfer vehicle of choice, given that other markets were in disarray from a liquidity and risk transfer perspective. So look at the investment grade ETF LQD. You know, on the high point, it traded $6 billion worth, $5 billion worth. And you look at the discount, it's just reflective of where the bonds were trading. And so there is a lot of discussion that the ETFs were trading at below fair value or at its posted NAV. I like to say that the way that the NAVs are constructed, the bond market is slow to catch up where the market is pricing real time where LQD was trading. So where you can freely buy and sell, the markets are fair. And I think that from the perspective of market structure, you know, it's probably some refinements are needed in order to bring more transparency in the online marketplace where bonds are trading real time.
Yeah, but I mean, you gave the answer there. I mean, the ETF haters want to say, oh, see, you know, this is the problem here. But it's not the ETF structure that's wrong. It's the way you price bonds. After this is over, Reg, are we going to have to rethink the way bonds work in the modern market structure? Is there a better way to do this? More electronic trading in bonds, for example. What's the solution to keeping that gap between pricing for the ETFs and the net asset value as small as possible?
Well, look, first of all, the bond market is $10 trillion. And if you look at the structure of the bond market, nearly, I don't know, 4 or 5 trillion of that is triple Bs. And so there's downgrades, you know, there'll be some repricing in that marketplace. I think what's needed most is some refinement, but more transparency where the bonds are being priced. And in my opinion, I've been talking about this for a week or so, that I think you need more transparency where bonds are trading in real time, aggregate where the prices are at, and find a best bid, best offer. So there's a lot of increased confidence where bonds are trading, just like you have in equities.
Right.
And so from
how do you get more transparency?
Well, I
how do you
think
get that? Is it electronic trading? What provides the transparency?
No, I think what you need, just like in equity markets, although bonds are different and the marketplace is larger, I think you need to aggregate under a SRO to basically create a security information processor and transmit where bonds are pricing real time. Listen, at the height of the repricing in the marketplace, a lot of the electronic algos didn't understand or didn't know where to price the bonds, and is only looking for customers to indicate where they're willing to buy. And so we have that scenario, like it occurred earlier this month. You need to have a lot of transparency to bring everyone in the marketplace and bring enough capital into the marketplace real time. So if you have a better structure around corporate bond trading by bringing the best bid, best offer, transparency, and transmitting that, I think more people have confidence where the underlying market is really trading, right, and not just rely on ETFs.
What you're saying implies that the current structure isn't working. I guess, do we need a new way of trading bonds at a new exchange or something like that? I'm trying to get into the weeds a little bit about this, but
I think we'll sit back and ask our questions. What went well? What didn't go so well? What did we learn? And look at the empirical data. And so if you look at the open-ended 40 Act mutual funds, you know, first of all, only 20% of the entire bond landscape trades per day. So that means that 80% of the marketplace does not trade or change hands. You don't have a real-time pricing agent. And so you have in the ecosystem a real-time, in the ecosystem you have a fair value agent that's picking a price where they think the bonds should be priced. And unless you have a real-time mark, you just don't know. So I think refinement of the entire corporate bond marketplace is in order. I know that there's a couple committees at the commission looking at this, and I think that there's a lot of evidence that we can point to say what went well, we did not. And what didn't go so well, in my opinion, is transparency of where the underlying corporate bonds are trading with respect to where ETFs are pricing in real time. Yeah. If market makers like myself, like GTS, go ahead.
Yeah. Let's hope that would be one great thing to come out of this. More transparency. The ETF structure is accurately guessing where these prices are supposed to be, just like they did with the China market. When China was closed for several weeks, the ETFs, the China ETFs that traded here, very accurately reflected where they would reopen. So it's obvious that it's the structure of the bond trading that's the problem, not the structure of ETFs. I want to move on here. I think we've touched on that enough. Nick, let me turn to you. BlackRock had a great report on Friday night. The ETF share of total trading volume in the month from February 24th to March 23rd, it was 27%. At the end of February, it went to 37% last week. So think about this, Nick. Nearly $40 of every $100 traded in the U.S. stock market is now done through an ETF, or has been in the last couple of weeks. This is unusually high. Does that have any implications for trading overall, given that most ETFs don't actually trade the underlying stocks? Most just trade between themselves. There's not a lot of creation and redemption much of the time when these ETFs trade.
Yeah, that's right. I mean, I think of it in sort of two frameworks. The first is short-term, where the ETFs basically took a lot of the load of repricing assets and repricing risk without having to go to the underlying asset, as you very rightly point out. And that's a net positive, I think an unalloyed positive. It allowed price discovery of asset classes much faster and more efficiently than going through and figuring out the underlying asset prices and then bubbling up to a top line. So that's good. The longer-term issue, which I think is important for the industry, thinking out 2, 3, 4, 5 years, is these kind of dislocations, these kind of crises tend to only accelerate the move into ETFs further, because whenever you see market volatility, you tend to see declines in asset prices, and it reminds investors that long-term returns have been lower than historical averages. And in that context, you want to have a transparent low-fee option for your capital, and that is the ETF solution in a nutshell. So I think there's a short-term issue where they worked well and helped price discovery, and a longer-term issue that says the ETF industry should look at this event and understand that the AUM is only going to rise further in the next 2, 3, 4, 5 years.
Yeah. Reggie, do you buy into that this will, what we've been seeing, will accelerate the move into ETFs, number one? And number two, Nick brought up a very interesting point, which is what a lot of the ETF haters bring up, which is the ETFs are leading the stock market. It's not the stock market that's leading the ETFs. Is there something wrong with that idea at all, or is there any reason for us to be concerned with that?
Well, I think investors who are not investing in corporate bonds for cap structure, but only for exposure, I think the passive vehicle or ETFs is probably the first route of choice, because going back to LQD, you can pick up an ETF that represents 1,900 different corporate bonds and have a exposure across the spectrum. And so for that perspective, just like you saw in Spider, when it was first launched in the U.S. in 1993, you see folks navigating towards the major mixed benchmarks in order to hedge their exposure. So yes, I do believe over the course of time that the ETFs will be the vehicle of choice for exposure and the hedging vehicle. As far as the naysayers, I think anytime you have a fair market where you have arbitrages and market makers like GTS is buying and selling an asset and then pricing real time the marketplace, the markets are fair and transparent and liquid. And so I don't understand the argument against having more transparency and yet more pricing and more capital, because it brings nothing more than efficiency in the marketplace. So efficiency is where I think investors will win in the long term.
Yeah. I want to bring up one other ETF tied to the bond market that I got a lot of questions on, and that's a VanEck's Fallen Angel High Yield ETF. The symbol here is ANGL. They track a market cap-weighted index of bonds that were rated investment grade but are now rated junk. Now, this is, of course, the highest quality junk, but it was investment grade. That's why it's called a Fallen Angel. And essentially what you are betting here, gentlemen, it seems to me that they're buying bonds that have downgraded to junk, so they're cheaper. So you're buying them when they're lower priced, theoretically, and the hope seems to be here that you're going to be able to eventually, they'll either move up in price because they'll stabilize, or they'll go back into investment grade, and it's sort of a buy low, sell high ideology. This is sort of like the highest quality junk concept. Reggie, I wonder if you could talk about these investment downgrades, these rating downgrades that are coming, and whether that's an interesting philosophy for getting into high yield in a sort of high quality way. People have been asking me a lot about this Fallen Angels ETF, so I wonder what your thoughts might be on this.
Well, I think, one, it's also a search for yield, and just like Investor's Choice with all of the junk bond ETFs, there's been nothing but a hunt for yield across the spectrum. So, Falling Angel ETF, where Van Eck brings it out, I think it's more of a bet around fundamental value and relative value with this ETF here. And so liquidity is here, I think, from the perspective of our investors looking at it. Absolutely. Why? Because it's a higher yielding product. And then, and as you state, there's opportunity for them to go back to investment grade.
Yeah. And Nick, just to end with you, Reggie's right. The investor interest in high yield has been enormous. CNBC viewers love high yield funds in general. But as we see here, they can act a lot like stock funds. They are essentially plays on credit, not plays on interest rate. And when you've got credit concerns like we've seen with companies maybe not being able to make all of the debt obligations, these things can go down fairly quickly. What is your data revealed about buying into high yield funds and the right and wrong time to get involved in them?
Yeah, your existential point is correct. They act a lot like stock funds, so you're going to have a high correlation, and that data shows that clearly, between equity funds and high yield funds. So you're getting basically a yield pickup with a equity-like near-term risk profile. It's important to understand, though, that the Fed chose the investment-grade market to backstop and not the high-yield market. And so for investors looking for some yield but wanting that bigger backstop, then the investment-grade side is the way to go. And it's important to understand the Fed did that for a reason. 25% of LQD is financials. It's banks. You know, the big banks are 14% of LQD, so the Fed had to backstop that. And in the Fed stress tests, the BBB market is part of the framework. The high-yield market is not. So it's a riskier perspective in terms of a final Fed backstop as well.
Yeah, that's a great point, Nick. It is buying LQD was partly a Fed's way of helping to backstop the banks, certainly the debt of the banks. I think that's a very good point. I'm going to have to leave it there, gentlemen. Appreciate your efforts to call in and keep all the shows on the air. That does it for this week's ETF Edge, guys. I'm Bob Pisani, and my thanks, of course, to Reggie and to Nick for today's show. Thank you for watching, everybody. We've been in many different places in the last couple of weeks here. You can find all of our latest videos right on our website, where it always has been, etfedge.cnbc.com. We're going to see you next Monday. We'll still be here, same time, same place. Everybody have a healthy, happy, and safe trading day.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.